In an industry dominated by giants, JKLAKSHMI Cement facing challenges of being a small player. It was 18th May and JKLAKSHMI Cement announced its Q4 and financial year results along with declaration of a dividend of rupees 5 per equity share, which amounted to 100% of the paid up value, and it was a trigger enough for the market to be flooded with buy recommendations, and the frenzy followed. The market build-up in the course of announcement of results also highlighted a small change in the promoter shareholding from 46.2% to 46.3% over a period of 1 year, and it also took note of mutual funds increasing their stake by 1.2% and FPIs growing their share by 1.7%. And these changes, although positive, got more than the highlighting they deserved in market's attempts to have a build-up for a price movement. The day following the announcement of results and the subsequent day, 19th and 20th, quantity just zoomed up from a level below 20 lakhs to above 1 crore, and price also went up along with the quantity, both having creation of a wave effect on the market for a brief period of 2 days. The order quantity and delivery percentage gave a real reflection on the quality and intent of the trades. Quantity went up with less number of orders, more depth per order. At the same time, delivery percentage, which was on a level above 50%, collapsed to sub 20%, and it was for all to see more of speculative bulge in order size and no intention of giving delivery, and so much for the quality of the upward movement. I am Vittal Prabhu with the weekly video on Stock Learning Simplified. Hope you will find the video interesting and useful. JKLAKSHMI Cement belongs to JK organization, a well-diversified group into tires, cement, paper, power and textiles. JKLAKSHMI is a reputed manufacturer of Portland cement and quite well known in the market for quality and integrity. Company's revenue growth during the last 5 years, taking the total to almost 5,500 crores in the recent concluded year, but the 5-year CAGR is a nominal 10.5%, whereas NPAT during the same period, because of the lower base in the beginning, is showing a better CAGR, and the NPAT percentage and EBITDA percentage have shown good improvement during the last 3 years, and EBITDA at around 18% plus is a very positive sign, but revenue has got a long way to go as its CAGR is not impressive enough. Cash flow brings out the positive impact of strong flowback and reduction of dependence on borrowings. Using its annual surplus of over 600 crores, more particularly during the last 4 years, the company has been able to fund the fixed assets requirement internally, and it has also substantially reduced its debts by making use of the additional cash available, and that reduction of debt has helped the company achieve substantial decrease in the finance charges and improve profitability. Data for the last 4 years of EBITDA and its relation with financial cost brings out the best of the company. March 2019, finance cost was taking out almost half of EBITDA for servicing debts, while it has reduced substantially, and the recently concluded year is making use of only 15% of EBITDA for servicing the debts, and as a result the finance charges have come down by a whopping 51 crores during the year, from 191 to 140 crores, and that is a great achievement. Incremental analysis of Q4 of current year and previous year throws up some uncomfortable questions. Revenue incrementally is 175 crores and the incremental material cost is 48 crores. Incremental freight is 53 and incremental power is a massive 99 crores. At this level, incremental loss is coming to 25 crores and there is a saving in employee expenses to the extent of 7 crores and as a result the loss comes down to 18 crores. And this 18 crore loss incremental gets converted into 11 crore positive by a whopping saving of 29 crores in other expenses, which is reportedly saving in the IPL advertising expense, which is non-recurring one. And the whole build-up of only 11 crore of EBITDA based on a non-recurring saving raises doubts on the talk of better capacity utilization, better mix of power to bring it under control, and better realization per ton. And these questions remain even after going through the entire details of Q4 achievements. Being small and compelled to work in an environment dominated by giants like Ultratech, Shree Cement, Ambuja and ACC is a threatening challenge to JKLAKSHMI Cement. Of course, it has got a lower PE multiple, but that alone is not enough. Cement industry with the big players going for consolidation, JKLAKSHMI Cement runs the risk of being marginalized, notwithstanding its reputation and integrity. And significantly, the recent incremental losses in Q4, mainly due to power and increase in material costs, makes JKLAKSHMI Cement more vulnerable than it appears to be. Candle movement within the Bollinger Band downwards from the upper end is suggestive of expected bearishness to follow in the very near future. The daily chart for 5 minutes suggests a descending incline showing a downward movement on a continuous basis all through the day and maybe to follow beyond the day. A look at the 5 minutes chart for the 3 days after the result, gap up opening and moving up with a consolidation at the end of the day on 19th, then a spurt taking it up with a massive increase in prices on 20th, followed by a lull and a downward incline on 23rd. Signs of the momentum losing its steam and price getting back to the long-term normal. Hope you liked the presentation on JKLAKSHMI, the efficient small cement plant under pressure from input inflation. You can access similar videos at InfoCard on Stock Learning Simplified. We look forward to your likes, shares and comments. If you are new to the channel, may please subscribe and press the bell icon for timely intimation on our forthcoming videos. Thank you so much for your valuable time, interest and support. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.